And I am absolutely being a snob. That is what's earned you the right to be on my show, is that you have fulfilled these particular boxes. So I'm excited to present you to my listeners. Now I'm going to read a bit of your bio, but I shortened it a little bit. So hopefully you won't mind too much. Hello, I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter. Today we have a great guest. Now, I don't invite people to my podcast unless they're a great guest. So Paul Moore is our guest, but Paul, just so you know, you are only on this because I have seen you present at my FIBI meeting. I have been recommended to you. I know that you're a published author. I know that you've helped other people move forward in their financial freedom and success. That's what's earned you the right. And I am absolutely being a snob. That is what's earned you the right to be on my show, is that you have fulfilled these particular boxes. So I'm excited to present you to my listeners. Now I'm going to read a bit of your bio, but I shortened it a little bit. So hopefully you won't mind too much. All right. So after graduating as an engineering degree after graduating with an engineering degree and then an MBA from Ohio State, you entered the management development track at Ford Motor Company. Congratulations. I don't know if that was great or horrible, but obviously you later started your own company. You were a finalist at Ernst & Young's Michigan Entrepreneur of the Year 2 years straight. You sold that company to a publicly traded firm 5 years later, and after a brief retirement, which I think we'll hopefully have an opportunity to touch on, you started to invest in real estate. And now I got to go through this list. I actually have to read the list. Okay, so you started in 2000. You flipped over 50 homes, 25 high-end waterfront lots, appeared on HGTV's House Hunters, rehabbed and managed dozens of rental properties, built a number of new homes, developed a subdivision, and started 2 successful online real estate marketing firms. Do I have the basic gist of your career down?
Yeah, it sounds exhausting.
It sounds exhausting.
No wonder I had to start a podcast called How to Lose Money.
That's right. And so now you are the author of The Perfect Investment, right? Create enduring wealth from the historic shift to multifamily housing. And you have your own podcast, which I don't know how many shows you have, but I know it's been around for quite some time.
Yeah, around
right?
200.
200. Nice. Yeah. Nice. How to lose money. Okay, now that's a whole new topic. I think that's a topic that we really need to have our listeners be able to understand. I mean, I've said this when we were talking warming up. You know, people think real estate is easy and going to make you wealthy fast. And honestly, real estate is a pain in the backside, but is well worth the rewards that it gives you, because it truly does drive you to financial freedom. And that's what we're gonna talk about. So let's start with the first, which is, just give us I already read your bio, but give us a very short understanding of what you did from real estate and the transition from being somebody who was an entrepreneur into real estate.
Yeah, absolutely. So yeah, thanks for having me on the show. I'm really honored to be here, Christina. I moved to Virginia from Detroit when it was imploding in '98 to the Blue Ridge Mountains of Virginia. We bought 120 acres out on top of a mountain, and we thought this will be a great place to raise our kids. And I actually started a nonprofit to reach out to international students studying in the U.S. And that was fun, but the people I had volunteering for me wanted to do a couple events a year. I wanted to do 2 or 3 a month. And so really, I'm a high energy type A entrepreneur. I was 34 by then, and I was very bored. And I thought I was going to be a great father, great husband, great friend, and I became the worst version of myself. And I found out, and thankfully I learned then, that I never want to retire. I don't see any reason for it. I don't see much historical precedent for it. And I want to move into different roles as the years go on, but I definitely don't want to or don't plan to retire because it was miserable, especially at that age. So that's kind of my history. A friend moved to town, and he didn't have a job, but he had a lot of history doing apartment maintenance. So we decided to go down to the courthouse steps and see about this rumor we had heard that you could buy houses for 50 cents on the dollar. Our first visit there, we bought a $65,000 house that could flip for that for $34,000. And all we did is sweep it up. And I think we might have painted one room and we flipped it and it sold in 4 hours. And we thought, this is going to be easy. We can do one a week.
Oh, well, yeah, easy.
Of course. We found out it wasn't easy at all. But that's how I got started in real estate.
You know, it's amazing because you just touched on, two things that we're going to talk about later, which is, the financially free and what it means to be retired. And also, what maybe was a hard experience in real estate. So let's talk for a minute, though. Let's backtrack and pretend to be more professional for a minute. It's so hard for me because all I really want to talk about is what it means to be on purpose in one's real estate life and investing. So that's hard for me to do, but yeah. I don't think our audience has an understanding. So tell us about your depth of history, what it is that you bring to real estate. I've done your bio, but tell us a little bit about you're used to specialize specifically in multifamily, The Perfect Investment, your book, your title, The Perfect Investment. Why are you doing something different now? So let's talk about that.
Great question. In 2011, I actually built a ground up multifamily with a partner. We owned and operated that for a number of years. That went really well. And I decided, I'll tell you, Christina, and we can stop on this point if you want. Once I discovered the math, the value formula for commercial real estate, I realized I never wanted to do anything else. And if I would have only known that in my 20s or 30s, I would have never done anything else. But I was in my 50s and we decided to do the Class B value add multifamily thing that so many millions, it looks like, are trying right now.
Yes, and, I'm afraid so.
Yeah. And so, the value formula is so powerful. I'll stop on that for a second. The value formula for commercial real estate is this, and most of your listeners probably know this, but the value of the real estate is the net operating income divided by the cap rate or the rate of return for that type of asset in that market at that time. And so by driving up the net operating income, you can proportionally drive up the value of the asset, which is very different from residential, where it's based on comps and you can't necessarily drive up the asset value just by moving levers and doing value adds. So we were very excited about doing multifamily. Like I said, I wrote a book on it, and we pounded our head up against the wall for years looking for the right assets, being outbid or choosing not to bid as high as the broker said. And I kept seeing friends who I said, hey, Michael Blanc or whoever, you're overpaying for this. And I'm really concerned about it. And then he would cash it in, sell it for, say, 3 years later for a huge profit. And so Michael and a lot of my friends were making all this money, but I still wasn't willing to jump in at what looked to me to be paying too much. And so even though they were right, I still feel like we've got to be close to the end of the cycle. So about 2 years ago, our team started looking for alternative assets, and we were so happily surprised when we discovered mobile home parks and when we discovered self-storage. And there's so many reasons I could dive into, but I'll just leave it at that for now. We decided to expand. We realized, Christina, that we didn't have a track record, we didn't have a team, and therefore we didn't feel like we could raise money for us to do these deals. So we pivoted about 2 years ago, and we decided to start looking for best-in-class operators in these asset classes, and then we would raise money and bring them equity for their deals. We're super picky. We've looked at well over 50 operators. We've only chosen 4 to invest with, and we continue to do that. And we're having the time of our life now in these 2 asset classes that I really love, and I can't wait to get back to multifamily, but the timing is just not right in my mind, for me at least.
Okay, so I got to break that apart a little bit because you just went through so many deep things that I'm not sure that my listeners are going to completely understand. So let's backtrack for a minute. The value of a property. Give the formula and explain the formula again, because that's part of your book, right? The perfect investment is because the multifamily asset or commercial asset has this value formula, and you can tweak it. You can force appreciation out of it in so many different ways. So do the formula again.
So Christina, just kind of broadening that just a tiny bit, true wealth, I believe, are assets that produce income. And I think that's why the Forbes 400 wealthiest people in the world, almost all invest in commercial real estate.
Yeah.
The value formula is why it works so well. So the value of the asset is the net operating income divided by the cap rate. And when you use leverage, you can even make that work even better. It works for self-storage. It works for mobile home parks. Very quick example. If I'm looking at an asset that has been hopefully undermanaged by a mom and pop operator, let's say, and it's making $100,000 a year in net operating income. Now that's the gross revenue minus the operating expenses, not including debt service, like, principal and interest, not including depreciation. That $100,000 a year, if I took that number and divide it by the normal cap rate for that market, and let's back up a few years and say more of a normal cap rate, just for this example, would be, let's say, 7%. Now, I know it hasn't been 7% in LA for a long time. But
I bought when it was 7%. I remember that. I'm old. It just tells you how old I am. That's all.
Okay, great. Well, you look great. So anyway, the cap rate of 7% would be dividing it by 0.07. So again, the cap rate is the expected rate of return that an investor would expect for that type of asset in that condition at that market at that time. So using 7% to make it simple, $100,000 divided by 0.07 is a value of 1.4 million and some change. So if you had an asset that was 1.4 million, you could go get debt on that for, let's say, for example, 1 million, and then you'd put equity in this case of 428,000. So 1.428 total plus some closing costs. Now, if you could go in, and if it was multifamily, you might upgrade cabinets, countertops, flooring, lighting, all kinds of things. And you would take that and you would you would add a dog park, things we've done. You would take some unoccupied units and hopefully get them occupied, maybe use Airbnb, etc. And let's say you could get the net operating income, Christina, up from 100,000 a year to 140,000. Very doable. So 40% increase over a couple of years. Now, let's take that. Let's assume the cap rate maintained constant at 7%. Now, that 140,000 divided by 7%, 0.07, is 2 million even.
Right.
Now, the increase doesn't go to the bankers, it goes all to the equity holders. So the equity holders at 428,000, they just more than doubled their equity, because now the balance of the equity is 2 million, the value of the property, minus the approximate amount of debt left. Let's say it's around $1 million. So it's $1 million. So while the asset value went up at 40%, the equity holders share went up at 100% over a couple years. Now,
that's brilliant. It's brilliant. Well, I love how you're explaining it, because, forced appreciation, people talk about forced appreciation, but I don't think anybody, at least I rarely hear somebody truly breaking down the numbers where it's like, this is why people come to real estate and say, real estate's easy. All you need to do is this math. You do this math formula and you can do something with it. And you can. And when you can find a multi-unit that has that level of deferred maintenance, and you can get it at a price that allows you to force appreciation out of it, it's a very successful process.
Right.
Which is why you wrote the book, right? The Perfect Investment.
Right.
That's why you did it.
Yeah,
now,
and chapter 8 is all about what I just shared. But you know what, Christina? I don't know that I really, really understood it on a deep level till after I wrote the book. It's kind of a funny thing. Not sure why that happened, but anyway.
We always understand it better when we're getting ready to teach it.
Right. I guess you're right.
Yeah, that's always the way of it. Because then you really delve into the nuances of how it can be seen from multiple different points of view. Right. And then you really go, oh, yeah, that's brilliant. It really does work that way and that way and that way. But enough about teaching. But then you switched over, right? You switched over to using the storage unit mobile home park because the multifamily market is
It is quite a bit overheated.
Oh, quite a bit overheated. That's what I wanted you to say. I was like,
Yeah, right.
It's quite a bit overheated.
Yeah, what I found out was 93% of multifamily, Christina, is owned by corporations, and they've largely wrung the value out of these assets. I'm talking about 93% of the multifamily over 50 units.
Over 50 units. Yeah, the non-mom and pop size.
That's right.
Right.
And so as a result, it's very hard to find something that has deferred maintenance, undervalued, mismanaged, et cetera, at this time. They're out there, but they're hard to find, and they're very, very competitive to buy these. Now, self-storage is very different. There are 53,000 self-storage facilities in the U.S. That's about the same as all the Subways, McDonald's, and Starbucks combined. And only 24% are owned by large institutionals, which means 76% are owned by independent operators, mom and pops, et cetera. And a huge percentage of these haven't been managed really, really well. You know, they used to believe the old motto, if we build it, they will come. Right. And people did for years. But now the opportunity is there, and this is an incredible opportunity to buy from a mom and pop, upgrade, force appreciation, and then put a few together in a portfolio and sell to an institutional buyer. It is a huge opportunity, but it's not going to last forever.
Right. Same process.
Right.
Different asset for the reason you just talked about. And the same is true of mobile home parks. Now, I can't remember how many, I know I've seen the statistic, but how many mobile home parks are actually owned by, people who own 3 or less and therefore are non-institutional owners and have that same level of deferred maintenance, inefficiency of management, small size. I know people who are like, oh yeah, this lot can take 70 units, but they only have 36.
Yeah, right. That's exactly right. There's so many, I laughed when I heard the idea of value add for self-storage. I thought, well, wait a minute. It's 4 pieces of sheet metal, a door, and a piece of concrete. How can
how can you value add?
What are you going to upgrade? But there are so
you're not going
many
to upgrade the stove. You're not going to upgrade, you're not going to add laundry to each unit. You're not going to, add granite countertops. Right. So tell us, how do you force appreciation out of a storage unit then?
Yeah, so there are several ways. Number one, a lot of people they do not price like hotels and airlines. They just give everybody the same price. And I've been into self-storage facilities where you'll say, so what's your pricing? And they'll pull out under the big pile of junk on their desk, they'll pull out an old price sheet that looks like it's been through several versions of a Xerox from years ago, and they have one price. And they haven't changed it for years. So they don't dynamically price. They don't react to the market. That's one. Number two, they don't do a lot of advertising. A huge percentage just rely on drive-bys and don't have a website. They're not using social media. They're not really maximizing their marketing. Number three, they don't sell insurance. Now, this may sound like a small thing, but if you sell insurance and you do a co-op on the insurance, you can make, let's say, $5 per unit. Let's say you have 800 units in a large self-storage facility. That's $4,000 a month. Multiply that by 12 months. That's $48,000 a year. Divide that by a 0.06. Let's say a normal cap rate. Look at this: $800,000
value.
So if I just paid $10 million for this self-storage facility, and I got let's say $3 million in equity, $7 million in debt, I just increased my equity by what is that? About 27%.
Yeah, I was going to say 20, a little more, a little north of 25%.
Right. Yep. And that's just by selling insurance. Another thing I can do is add U-Haul. Now, adding U-Haul or Penske truck rentals doesn't cost anything to my CapEx. It's just a policy and procedure change. It means my front desk employee has to work harder. That can add $3,000 to $5,000 a month to my gross revenue. Since there's no significant cost involved in that, that goes straight to the bottom line. Guess what? That's another $600,000 to $800,000.
Yeah, I was going to say, we just did that math on $3,000. We know what that is, right?
Right. So it is really powerful. There's all kinds of things like that. You can also add a beautiful showroom, sell locks, boxes, tape, and scissors. And one more thing. a lot of these self-storage facilities run by mom and pops have extra vacant land.
Yeah.
If you put a 2 or 3 story beautiful climate controlled facility on that vacant acre, especially if it's out near the road, you can significantly, since the land's already paid for, significantly drive more revenue for your facility. And so these are the types of value adds that are allowing our investors to see, well, surprising ROI in the results, in the level of 40 to 60% per year sometimes in ROIs, which is something we haven't seen in multifamily as much for a while.
No, multifamily has been topped out for too long. Like you said, it's been squeezed by the profession. It's been professionalized. I keep saying it's not just that it's professionalized in that 93% of it is owned by institutional, but it's also been professionalized in that what is left, there are several professional companies like Gelt and Post and, even you guys, Wellington Capital, right, are out there specifically looking for that. Although I know you're now looking for professionals, like instead of you, Wellington Capital, looking yourself, you're specifically looking to find those who have put in the infrastructure to be able to acquire.
Right.
And not in the multi-unit market, because we know that that's been so flooded, but specifically here in the storage. And you said mobile home park as well, right?
Right. Yes.
Right. And it's great because, you bring your knowledge of what needs to happen and your history of what needs to happen, because we're about to go to history, right? Your knowledge as far as mathematics and your book and your history as far as like having seen it go wrong, that's what you really bring, right? So let's talk a little bit about your podcast then. Your podcast, How to Lose Money. Okay, I love the title. I really do. I love the title because that's part of, like I said at the beginning of my show, real estate's great and it's well worth it. I've lost money in real estate. I lost money in real estate more than once, and I've had to pick myself back up again. You call it by the bootstraps, right? The American dream, pick yourself back up again by the bootstraps and say, I'm not going to give up. I'm going to move forward. And I've only become a better person because of it.
Right.
So tell us your hardest moment in investing and why you call your show How to Lose Money.
Well, I'll do that in 2 separate answers. First of all,
that's good because it's 2 questions.
I'll tell you that, Christina, for years, I would go to these seminars, these events, and on the stage would be one person after another telling their amazing success stories. And they were successful. It was great. But you know what I noticed? The people around the table when we do breakout sessions would be slumping down in their chairs. And they would literally say things like, I could never be that way. I could never do that good. I don't know how he got so many good breaks.
Right.
Well, over the years, I found that I got to know some of these people on stage. And I said, wait a minute, they had the same struggles that I did.
Yeah.
They have the same fears and insecurities and losses that I have. And I thought, wouldn't it be encouraging if we just told that side of the story? Jim Rohn said, if we could only do webinars and seminars where people tell how they lost money, we'd all be so far ahead. And so we decided to put together a podcast teaching people, or at least telling people the history of people who have lost money, time, relationships, and health on their road to success. And we've had a great time doing this for over 3 years now.
That's brilliant. I think it's brilliant because it thinks kind of like I think. So, of course, because you think like me, you must be smart, right? So, but I think it is actually a really good idea. So tell us then, what was your hardest moment in investing? And obviously, how'd you solve it? Because, obviously you didn't walk away from it. You're still in real estate.
Yeah, right. So in 1997, I had a couple $1 million in the bank. I told you I was 33. We sold our company. Exactly 10 years later, in November of 2007, now keep in mind, we did not know the hole we were plunging down. So as you're listening to this story, try to remember what it was like not to have known that we were about to plunge into this huge black hole called the Great Recession, right?
Yeah, I was there with you. I had the same problem. Go ahead.
Yeah, right.
Preaching to the choir, but keep talking.
Right. So, and we didn't know, we actually had seen, the real estate market already really chortling and wheezing for about actually a year and a half, I'd say 18 months. And so we were hoping the worst was over, little did we know. And so I found myself $2.5 million in debt because we were flipping these high-end resort level waterfront lots.
Right.
And we owned a bunch of lots. Well, my partner comes to me at that time and he said, hey, I can't make half of these interest payments anymore. I'm done. I'm signing everything over to you. You can have the ownership. You can have the debt. I'm out of here starting January 1st.
And you get all the payment too.
Yeah, that's right. All the
payment.
All
the payment, right.
And so Ted and I are still good friends. We still work together in another business. But at any rate, Ted walked away. And so I was sitting there one morning. I do this morning meditation thing. And one morning I came up with this thought, WWGMD. Now, that doesn't mean what would grandma do. It means what would George Mueller do? Now, George Mueller was this hellion in Germany in the early 1800s. He became a saint in England, and he actually began to care for thousands of orphans on the streets of Bristol, England. And he had all these radical beliefs about what you shouldn't do. He didn't think you should ever ask for money. So he basically never asked. He believed that if he was doing the right things, people would come to him and money would flow to him. And it did. And it's believed that he raised over, in today's dollars, perhaps $300 to $500 million because he cared for a total of 10,000 orphans through the 1800s. Now, George Mueller, one of his radical beliefs was he hated debt. He didn't believe in it. And so I was already in trouble if I was going to do what he did. But I thought, what would he do to get out of debt? And then I realized, well, he'd probably start something radical like giving his way out of debt. So I met with two friends about that time, and they said, hey, what are you going to do? Are you going to declare bankruptcy? And I said, no, I'm going to give my way out of debt.
And they're like, okay, Paul, you've gone over the deep end.
Yes, that's exactly what they said. They looked at each other with this worried look, and I knew that they were really concerned.
Yeah.
Then I went home and announced to my family the same thing. We're going to give our way out of debt. We started giving a set, pretty substantial amount to some charities, nonprofits, church, things we cared about. Every week, once a week, we gave the set amount. It was very painful. 4 weeks later, though, I was in a restaurant and I was talking to a real estate developer. I was telling him my situation. I told him about this 5-acre waterfront parcel that I had planned to divide into 5 1-acre lots. And I said, if I could only divide that and make that huge profit, then I would probably be out of the woods here. He said, well, you ought to try this. And I said, yeah, that won't work. I already tried that. He said, well, think about it. And right then I had this amazing light bulb moment. And to make a long story even longer, I actually 2 days later was sitting in front of the county planning and zoning commissioner, and I laid out this crazy plan, and she looked at me and shook her head like almost shaming me. And she said, I have worked here for decades and no one has ever presented such an outrageous plan. And then she smiled. She said, but you found a loophole in our law. And you knew what you said. So now, I won't say it was easy.
So she gave it. So she gave it to you. The point is she said you found a loophole and we're going to give it to you.
Yeah. Right.
Okay. Now go on. You said it wasn't easy because that's part of the story. Part of the story is
that was month 1 and then there was 13 months ahead. There was a lot of bickering with a bank or 2 banks. There was actually attorneys involved, surveyors, soil test engineers, and of course I had to find 5 buyers for these waterfront lots when nobody was buying waterfront lots at that time.
Not land.
Quite the contrary.
Yeah.
Well, I actually was able to put a cherry on this Sunday. I was able to sell 3 of those 5 lots in the very, very worst weeks of the recession, which would be September of 2008. And we continued to hurtle down this hole. I was able to sell all 5 lots, and I was completely debt-free 13 months after I started giving.
Okay, that's an amazing story. I have more questions for you. That's an amazing kind of crazy story, but I have more questions for you.
Okay, fire away.
How do you think it helped you grow up? Is my next question.
Yeah, it really helped me realize, some people call it karma, some people call it the law of sowing and reaping. I would say that it really convinced me that that was a universal truth that was absolutely true. Now, I do not believe there's some vending machine in the sky that you can just put in, $1 and get out $10. I don't believe that, but I do believe that that's a general universal truth. And so that helped me a lot. Secondly, it allowed me to realize that when I had a deep, heartfelt conviction, it might go against everybody's advice, but it was okay. And third, it was a great lesson for my kids because they got to see me. I don't remember losing any sleep during that time. And now I'm actually kind of puzzled about that. Like, why didn't I lose any sleep? Why wasn't I more worried? I wonder if I even realized the gravity of it, but I actually remember being peaceful through the whole thing. So it was truly amazing.
Well, that is important to understand. I mean, as you're trying to dig your way out of what seems like would be somebody's nightmare, right? I mean, being that deep into debt. I mean, I know somebody right now who's got more debt than they can possibly sort out. And I know that they're panicked, and I know they're not sleeping well. And I know that, and they're dealing with investors and upsets. And I mean, I talk to this person every day right now, and if I were to say to this person, give your way out, I think they'd be like, I can't do it. I can't find peace to give I can't find peace, and I can't give my way out.
Right.
So why do you think the peace was there? I'm going to challenge you to go. Was it because you had chosen this radical point of view? Was it because you knew that giving moved you to a different place? Was it because divine intervention? What would you say it was connected to, or all of the above?
I'm not 100% sure.
Okay.
Because about 3 or 4 years ago, I had something that was minor compared to this that actually I laid awake at night for some, not a whole lot.
Right.
But I think it was divine intervention, I guess. I guess, I really truly believed that I was on the right path and that this was going to work out. In fact, I even warned my business partner
that
he shouldn't get out. I said in January, I said, hey, are you sure you don't want to rethink this? Because I really think I'm going to get out of this with flying colors. He missed out, by the way, on literally hundreds and hundreds of thousands in profit
by signing on.
And, he didn't do anything wrong. I don't blame him. But it really actually, and think about that. That was even part of the story. If he hadn't got out, I would have only made half the profit on all those deals. I wouldn't have been debt free.
Well, and you may not have been free to follow what you knew was the right choice for you.
Yes.
Right. I mean, it's like here's this crazy plan that Paul comes up with that, who else is going to agree to it other than maybe his wife who says, okay, honey, whatever you say. Yeah. Right. But I think the thing that I want to, if I may, slide in here, is that you knew that you were on purpose with your plan. Mm-hmm. Right. It's like,
that's right.
Yeah, it's crazy, but I can see the end result. I can see it can work. And therefore I know I'm on purpose with it, whether it's divine or spirit guide or just good, sound self-belief.
Yeah.
And not sliding into self-doubt and overwhelm and fear.
Right. Yeah, you're right. That's right.
I don't know. I'm just laying it out there. Because my next question is, when you look back into that time, what is it that shifted you and helped you break through in you committing to succeeding and not committing to fear?
What is it that caused me to do that?
Yeah. When or where? What was the moment? I have a moment. I can remember that choice. Right. But maybe you have a place or a moment or just I don't know.
Yeah.
What do you have?
It's funny. I can tell you the moment.
Tell me.
It was that morning. I was sitting in my leather chair. I remember how I felt. I remember the room, and I felt a deep conviction that this was right. This George Mueller crazy idea. And I actually went to church later that morning, and I hadn't ever heard the pastor ever mention George Mueller. I didn't know if he knew who he was. He's a little obscure. Right. And he mentioned him actually quite a lot in his sermon that very morning. Ooh. And so I was like, okay, that's it.
That's it. I'm sorry, I'm getting goosebumps. I apologize. I didn't mean to step on your story. No, it's that's great.
Yeah,
that's great.
What happened. That's just the truth.
That's just the truth. Yeah, because I remember what position I was sitting in my chair. That's how visceral it is for me when I had that moment.
Yeah.
So All right. So what we talked about, like financially free, we've got a few minutes left. We talked about, you worked really hard, Paul, not in real estate to get financially free. You worked really hard by running your own company. And running your own company is a little like real estate. It can be really worth it, but it can also be really difficult.
Right.
Like, what is it that made you so driven to be financially free? What were you trying to avoid or move away from? Or what were you moving towards that made you work so hard to get there?
I don't think I really realized until we were ready to sell the company that I would be. So honestly, I was in my late 20s, early 30s. I was thinking just about doing the very best job I could to serve our clients. I wanted to make more money every year in and year out, but until we got an offer for several $1 million to buy our company, I don't think it even dawned on me that there was a value of the firm in addition to the income I was making. And so honestly, I think that was one way I was a little naive. And now I see that very clearly. But, I was only 33 at the time.
It's hard to imagine you ever being naive, Paul. Not with your brain power. I'm just saying.
Well, you know how it goes. I mean, I wanted to be a parapsychologist all the way up through my junior year of high school. Okay.
See, there you go. Now you end up being something completely different.
Right.
So let's go on to the next piece of the story then. Is now you're financially free and you're in your early 30s. I believe you said 33 or something.
Yeah. Mm-hmm.
And you're retired, the American dream. You're retired. Why was that the American dream for you?
Yeah, I thought it was. I thought, that I could actually, I had this problem, and it was right between my ears. I actually believed that I would be a better person, that I would be more spiritual, that I would be fulfilling my life's calling more if I got out of business, which I thought was it's just business, and did something more important, so-called important. And so I jumped into this nonprofit, like I mentioned, and tried to run that nonprofit. And I thought that would be a better path for me. But I didn't know that my calling, my gifting, my passions were actually in business, and that I would have more opportunity to impact the world for good in business than I would from running this nonprofit. And so that took many years to sort that out. But thankfully I have now.
When did you sort it out? So you were 33 till what?
50.
Dude, Paul, come on. I thought more of you than that.
No,
it's kind of slow.
30s and 40s that I thought, well, if I can only get to where I'm doing nonprofit work. And I didn't realize that they were, it wasn't better. It's not a higher calling to do nonprofit work than it is for profit. I mean, there's so many examples of that. And I mean, I'm involved in a project right now. I'm very, very passionate about fighting human trafficking and rescuing its victims. And we can talk about that if you want to, but I can tell you that, I can tell you that in the for-profit world, I'm having way more opportunities to speak to that issue and to help that issue than if I started some nonprofit up to do that.
I think that I just sing inside when you say, like, our purpose isn't always found in the nonprofit charitable world.
Right.
It's held up as, well, a good person would do that. If you're truly following a spiritual path or a religious path, then obviously that would be the right thing to do. But it may not be your right thing to do.
Right.
It may not. Right. It may not be what you have to contribute. And then, like you said, when you're in the business platform, you actually can create a deeper, further reach by being in that platform.
Right.
So let's talk about, we actually have a little more time. Let's talk about the human trafficking and the difference that you're making there. Let's give some time to that platform.
Christina, did you know that if you took the record profits, not the average, the record profits of Apple, GM, Nike, and Starbucks, added those together, double that number, that would be the approximate revenues they believe are generated by human trafficking every year.
Oh my gosh.
Yeah.
I don't know what to do. I mean, that's so startling to me because to me, it's a direct relationship of numbers of bodies.
Right.
Numbers of people.
That's right. Right.
I mean, I'm sorry, call it the multifamily investor in me. That number is divided by a certain number of doors. I mean, come on, that's a hard number, Paul.
Yeah, it's
That's
staggering.
a hard number. That's staggering.
And so I like to believe that if I was alive in the 1800s, I would have been an abolitionist fighting against slavery. If I'd have been an adult in the 1960s, you might thought I was, that I would have been fighting for civil rights. Well, this is a civil right. It is slavery. And there's tens of millions of people being enslaved. In fact, since we started this podcast, likely over 1,000 people have been enslaved since you hit the recording button. So it's really serious, it's really awful, and it's right in front of us. And so I would like to get the word out to people to get involved and to do something. There's a great film out there called Nefarious.
Okay.
You rent that online or probably watch it on YouTube. And it was an eye-opener for me into the horrors of this realm. There's an organization that put that together called Exodus Cry. They're based in Sacramento. And I highly recommend that people check them out and consider giving to that. Another thing we're doing is we're building, and we haven't started yet, but we're planning a $1 billion office tower in Dallas called Freedom Place Project, freedomplaceproject.com.
Okay.
And we're not taking any donations. We're going to build this as a normal for-profit building, but we're going to give 100% of our developer profits to fight human trafficking and rescue its victims. And we hope to do this in other cities in the future.
Wow. I mean, my brain's still reeling. When I think about the size of the problem you just described and the size of intervention that might be required, right? I mean, again, it's my numbers head. I apologize.
Right.
You know, I mean, an apartment building, an office building in a downtown, and I don't remember which city, I apologize.
Dallas.
An apartment building in downtown Dallas, and the revenue, the profits from that being donated to this may not be enough. It's a contributor, but it's not enough.
Right.
You know, and part of it is awareness. Part of it doesn't have to be solved by money. It can be solved by awareness, but still, I mean, so I can see why you would do multiples of those in order to make the difference.
Right.
And I'm so glad that real estate, from my experience, this is an old joke, and I'm pretty sure you've probably heard it from me, and maybe my listeners have already heard it. Like, I remember when hard money used to be, you knew somebody who knew somebody who knew Gino. Now you knew this guy named Gino, right? And that's how you got hard money, right? And the field has truly moved from high sales, high pressure tactics, right? To no, where actually it's about integrity. And if you don't practice integrity, then your field, your community will actually declare that. Like I can even go through, like, just 6 months ago, this thing happened at a meeting that we felt like was out of integrity in our network, and our whole network now knows about it. And so that person's not now not welcomed into our network anymore. And it's not we're trying to be mean. We're not. We're just saying this isn't the playground that we play that way on. Right. We just don't do that. Right. When we don't allow that, and we don't allow our meeting members to be exposed to that. Right. And it's our heralding call for how to participate. Right. And so, so it's great. The field has moved into that. And so I could see how you would be able to move that forward and get other investors and other people that would say, yeah, the purpose of financial freedom is to end human trafficking. Right. That's the purpose of it.
Absolutely.
Not about my retirement, not about being bored at home, and not about pretending to find something useful because somebody else deems it that way.
Right.
But finding what's useful because it calls to me, it fulfills me and fulfills my purpose, and I can make a difference with that momentum and that grace. Yeah.
Well said.
Oh, thank you. I appreciate it. I'm a little passionate about it. So thank you.
Yeah.
I appreciate the platform.
That's great.
So, I that is my questions for the day. And so if you would please, let's give out some very important information. So let's talk about Wellington Capital, how people can get a hold of you. Let's talk about your book and your podcast, how people can find it. And let's talk about human trafficking.
Okay.
And those websites that you gave away before. So let's give it all away again.
All right. So I find that a lot of people want to be involved in commercial real estate, but they don't understand who to trust or front door, how to get in. We've made it really simple. Wellings Capital has put together a 5-part e-course, and people can get that by going to our website. It's wellingscapital.com. That's WELLINGSCAPITAL, wellingscapital.com. You can get an ebook on mobile home park investing, another one on self-storage investing, and then this 5-part course to figure out where you can get in if you want to invest. If you want to check out our podcast,
I'm gonna interrupt for a minute. Are you ready? Here we go. All right. I like to do this. Sorry to interrupt you. There it is. Wellingscapital.com. There's your website right there. And so how do they find some of this information physically on your website? Oh, there it is, right down below.
They can just put a /resources. And I believe, we just overhauled, believe it or not, the website about 4 days ago. And so I'm not sure it's all there, but I believe if you put a /resources instead of media, at least by the time this goes live, it will certainly work. SOUR resources. Yes, that's correct.
Is that it?
No, actually CES. Sorry.
SOUR CES. Let's see what we get.
So let's see if that works, but if it doesn't, it should by the time this goes
There you go. Resources sign up. Perfect. That's perfect.
And if you want to go to check out our podcast, you can check out howtolosemoney.com, or you can check us out on iTunes, Stitcher, Google Play, etc. That's howtolosemoney.com. And if you want to chat about, again, how you can invest with us or with somebody else, we'd love to talk to people. You can sign up on our website to schedule a time.
Okay. That's you. And that's your podcast. Give away the information about the human trafficking again too, please. The Nefarious.
Nefarious film. I highly recommend it. It's not for the faint of heart. And then I recommend that you consider giving to places like Exodus Cry. That's EXODUSCRY, exoduscry.com.
Okay. And you gave a website for the building too, Freedom.
Yeah, freedomplaceproject.com. You can see what we're up to. We're not taking any donations, though. There's no need for donations.
Paul, I appreciate your time. I appreciate your character and your integrity. And I appreciate all that you're doing to fulfill your purpose in this world to make it a better place.
Thank you. I appreciate you. This is amazing.
Really wonderful. Thank you for sharing your story. Hopefully that's inspirational to other people. Thank you so much for listening to the Real Estate Breakthrough Show. I am Christina Suter, your host and producer, and keep tuning in. Paul, you are an amazing resource to us. Thank you.
Thank you.
Goodbye, everybody.